Great. So welcome you again to the question solving section. Good. So illustration one. Okay, let me raise the question again on the A Limited. A Limited company has been valuing its closing inventory under the weighted average cost method. In 2013, management decided to change its accounting policy relating to valuation of inventories to first in, first out, that's FIFO method, since it was considered to, to be more accurately reflect the usage and flow, even flow of the inventories in the economic cycle. So you are required to explain whether the change in accounting policy is justified. Is it justified? So that's the answer. So that's the question. We are looking for the answer. So is the change justified? Meaning, is it backed by the relevant IFRS? So that is it. So with regards to IAS 8, that's the relevant IFRSs that look after changes in accounting policy. You can only change your accounting policy if there are two conditions. What are they? One, if it's permitted by what? IFRS. Two, if the change what will present reliable and more relevant presentation of the transaction and event, then you are allowed to change. So these are the only two conditions. So let's see whether they've got it right. So whether they've got it right. So in fact, IFRS is the first point. IFRS is not there. But here, any of them, if you satisfy even one of the condition, the change is okay, it's justifiable. So you can go ahead and then do the entry. So which of these two conditions are they satisfied? Or they've not even satisfied any of them. So they can't call it a change in accounting policy. Good. Any suggestion? So it means that good. Now here you realize they are saying that to represent more accurate, reflect the usage and flow of inventory. So it is what? It will make the financial statement reliable and what? It will justify the economic cycle, economic cycle of the entity. So in a way, the second point has been what? Satisfied. The second point stated that, here's the second point. Good. It will result in a reliable and more relevant presentation of what? Event or transaction. So here, when they do that accurately, they can report on the inventory, and it will reflect the even flow of the inventory in the economic cycle. So hence the change is what? Justified, or it has been justified since the second condition has been what? Satisfied. Full stop. We are done. Please, before you answer this question, make sure that you quote the two conditions for us, oh, and then you tell us which of them they've got it right, oh. Even if the conclusion is wrong, you stating the two conditions for us, at least we mark you two ticks, and then plus the conclusion, making three ticks. So if you go straight and go and conclude, yes, they got it right, one tick. Oh no, they got it wrong. In fact, we've lost everything. Everything gone. So you can even code the condition for us and still tell us that you got it wrong. You got what 2 takes out of what 3. That's far what better. So anytime the examiner asks you, can they record something? Is it justifiable? Please don't go straight forward. Give us the rule or the principle behind, and then second, tell us whether they've got the principle correct or they got it wrong. That's how we answer most of our questions. Good. So you realize that that's the same way it was being answered there. So it's there. Good. So let's go to illustration 2. That's the calculation. Illustration 2. So illustration 2. Illustration 2. That's Bright Light Limited in page 23. Good. Now, in 2013, Bright Light Limited changed its accounting policy relating to the valuation of inventory. Before 2013, the inventories were valued under the weighted average method. In 2013, the method was changed to first in, first out. That's FIFO method, because it was considered to be more accurately reflect the usage and even flow of the inventories in the economic cycle. The impact of the inventory valuation was determined to be so December 31st, 2011, an increase to 10,000, increase to 15, increase to 20. So they are there. Now they'll give you financial statement. That's the interesting part. The income statement prior to the adjustment are or income statement before taking into consideration what the change in the accounting policy. This is the accounting policy, not estimate, right? Because we said that for accounting policy, there must be change in what? Recognition, presentation, and what? Measurement. I remember, right? That's good. That's good. That's fine. Now the financial statements are there, starting from sales for 2012 and 2013. For change in accounting policy, to be specific, most often we will give you the current year or the year of change and then the preceding year, that's the year before. So if the change occurred in 2013, then we give you 2013 and what? 12 financial statements. That is it. It's for a reason, for what? For comparative information purposes. Good. And for open balances too. So the financial statement is there. They have to give us the retained earnings. So they say the retained earnings as at 31st January, sorry, as at 1st January 2012 was 300,000. So that is it. Now let's look at the solution. So let's go to the board. So what's the requirement? You know the requirement. It's an illustration. So we ask the question and answer it by ourselves. So I'll put the requirement there. Required. Prepare a relevant extract in the statement of profit and loss, and then the statement of change in equity into bracket retain column only for Bright Light Limited for the year ended 2013 and 2012 as what comparative. So that's a requirement. You can go to the tutorial questions and copy the same. You can see some of the requirement there. Almost all the illustration, we didn't add a requirement to it. So let me go to tutorial questions. Good. So have you seen the requirement for the first tutorial question there? So prepare the statement of profit or loss account, and statement of change in equity into bracket retain earning column only for the current year and the previous year as what comparative. So that's how we are going to also state over here. Good. So that's good. Now let's go back to the solution. So first, now let's go to the board. But a similar question like this dropped in the 2018 November. So once we go through this, you should be able to solve that one also for me. Good. Now first, locate the change. Tell me the change. I have steps. The steps that you have to go through, they are one. The steps that you have to go through when it's a change in accounting policy. Step one, identify the item, the item of what change or the policy. So first, identify the new policy, or the item of change. Then two, tell us the affected area or the affected item, or items. Let's make it like this: affected item or item. Sometimes they will change one policy, but it will affect like 2 or 3 items in the financial statement. Sometimes they will change one policy to affect only one item. That's it. And then lastly, the impact. And then fourth one, now you solve. You now prepare the extracts. So first, tell me the new policy. Tell me the old policy. That's the stage one. So step one, we were told that the company, they were using weighted average cost method. Now they are using what? The new policy. They've changed it to what? FIFO or the FIFO method. So that's the step one. If you're able to identify that, better than everybody can do it, right? That's good. I like that. That one, you can do it for me. You are fine. Yes. So after reading through the question, you should know. Formerly, they were using the weighted average cost. Now they want to use what? FIFO method. First, tell us if they change, it's about inventory valuation. So it will affect what? Inventory. So it will affect inventory. To be specific, which type of inventory? The closing what? Inventory. How we get it? To be specific, closing inventory, not the open. Good. And then the impact depend on the whether it will increase it or it will decrease the closing inventory. You are done. If you're able to analyze it this way, it will probably help you to answer some of the questions. So I will write the question here nicely again so that you tell me the impact. I'm on the impact. If you're able to get the impact, then we are done. After you know the affected area, all the other items that they presented to you in the financial statement, we call them free marks. Just copy and paste them in your solution. They will not be affected. Because now you know that inventory, when they change it from weighted average to FIFO to affect the closing inventory valuation. And inventory will affect cost of sales, right? So indirectly, it will affect cost of sales. Because closing inventory is in cost of sales. So if you know this, the rest, they are the same. So any other item which does not depend on cost of sales is still the same, to no change. So in a question, even if you cannot do the issue, not the other item that they presented in the question, just carry them and go and paste them in. It takes for you. Except for 2018 November, where the examiner was very smart, and they didn't give any free figure. No free figure. That one, the items that you need was the one that they presented them there. So all the items will have a purpose. So that's it. Now this is the impact. the impact. Let's see how best we can determine the impact for this question. I'll summarize the question on board for you. Let's assume that when you use the weighted average cost method, and then when you use the FIFO, and then the impact or the effect. So for 2011, 2012, and 2013, good. So now you're going to tell me, let's assume that weighted average. When you use the weighted average method, for 2011, they will have, let's say, 5. But FIFO, they are getting 10. 2012 to, for that of for that of weighted average, they are getting what? 10. Here they are getting 15. Over here they are getting 15, and here too they are getting what? 20. So tell me the impact. The impact is that because we have changed the accounting policy on inventory, this is the right one. This is the right one. But because in the exams you want to make things look horrible for you and terrible for you within that 3 hour period, you are not going to record the right one in a question, no. So you told you that if taking into consideration what this, the wrong one, or the old policy. So they've used the old policy to prepare the financial statement. So what do? You have to pick date and convert it to suit what the new policy. You are done. Now, this is the issue. So the impact will be this. So from here to here, that means it will increase the inventory by what? 5. Increase it by 5, so positive 5. From here to here, it will increase also by what? 5. Increase it by 5. Please, here is coincidence that is increasing all of them by 5. How we get it? Good. So that's fine. Good. So that is it. Sorry, I think I'm telling myself. So that's the impact. So that's the first thing you have to do. Tell us the impact. Okay, to increase the inventory by 5. Meanwhile, they've used this 5 in the calculations. What do we do? They've used these figures. Okay, if I've used the 5 in a calculation, then let me top it up by what? By the 5. So the closing inventory of 5 that they've already used is wrong. It's the old policy. Not that it's wrong, it's the old policy. Now we are in the new policy. So you have to assume what? 10, but not 5. That is it. Now, a critical example. Good. So where did you get these figures from? Yes. But these figures are imaginated figures, but they link to the question, like explaining the actual source of the question. This is how you're supposed to present the question to you. That weighted average, there is a value. FIFO, there is a value. So that you decide and choose the new policy, the right one from it. So yeah, I'm using my own figures, but it relates to the question that we are solving. In fact, these are the questions that you see. These are the questions. These are the figures in the question. Let me even show it here. You can see that the impact, the impact. So December increased to 10,000. So that's FIFO to be 10,000. And then that's 2011, 10, 2012, 15, 20, 2013, 20. Good. For these figures, I brought them from the question. These figures, I brought them from the question. Good. So that is it. I brought them from the question. But here I designed it myself. Just that's the original version. That is the original version. But that's what we're supposed to publish it in the question. So that is it. So now this question, this is how you're going to solve. So it means that in at all level, it will increase the inventory by what? 5,000. So inventory will be increased by what? 5,000. That is it. So now tell me, now that we know the impact, how do you treat it? Their inventory has been understated. That's the term. So the inventory has been what? Understated. Because when they use the old policy, it's 5. New policy is 10. So inventory has been what? Understated. So how do you correct the understatement of what? The inventory. So if inventory has gone down by 5, then what do? Let's stop it out by what? By 5. So you have to add 5 to what? The inventory. Add what? 5 to the inventory. But here, they did not separated the closing inventory. The closing inventory is inside what? The cost of sales. So it means you have to look at the impact on the cost of sales. So when they understate the closing inventory, what happens to the cost of sales? Does it goes up or goes down? So that we look at the the correct treatment. How we get it? Yeah, they give us cost of sales of what? 100. So that is it. And then after you analyze this, the rest, that's all. You just copy from the question again and put them in. So that is it. And you'll be fine. Good. So now let's see. Let's go to our basic principle, elementary. Yes, how do you find cost of sales? Let's take our own question. Cost of sales calculation. It's composed of 3 items. Opening inventory, maybe it was 100. Purchases figure. Purchases, let's say 300. Closing inventory. Now, we've made it 50. We have understated it. In the actual sense, this is the wrong version. This is the right version. The right version, still open inventory is still 100, purchase is still 300. But the closing inventory is supposed to be 150. But we have understated by what? By 100. So you are looking at the impact. And when you go to the exams, you want to see something like that, you can use it. Wrong version, right version. So what's the closing? What's the cost of sales? So the cost of sales over here will be what? 400. That's 350, right? Meanwhile, the actual cost of sales must be what? 250. Have you seen 200 or what? 50. That's the actual cost of sales. So it means that the inventory has been understated by what? By 100. So the issue is, okay, so they have understated by 100. Now, it means that they have subtracted what? Lesser amount. Cost of sales, closing inventory, subtract. You're supposed to subtract 150, but you subtract only what? Only 50. So it means that it will cause the cost of sales to go what? To go up. So that's why here the cost of sales is what? Up. In actual sense, it's supposed to be what? 250. So what do? Okay, they're supposed to subtract 150 and they've subtracted only what? 50. So let me subtract the remaining balance for them. So again, error or new policy. By method of the policy, I have to store less what? 100. So therefore, it will give me what? 250. We are done. So that means understatement of inventory will cause what? The cost of sales to be what? Overestimated. And then if you overestimate your cost of sales, what do? Profit will go down. So profit will go down. So the higher the cost of sales, the lower the profit. That's good. So that is it. So in short, I was trying to explain that this we are going to what? Subtract it from the cost of sales. That's all. And I've given you a proof of it. Why are you subtracting from cost of sales? Because you are going to subtract because they're supposed to subtract a full figure, 10, but they've subtracted only 5, so left with 5. Let's go and do the remaining subtraction to bring it back to the normal level. How we get it? So in short, we are going to what? Subtract 5 from the cost of sales. The remaining items are the same. So now this is how we will start the work. So now that we know that we're going to subtract 5 from each year section, let's set the tone for the solution. So first, the name of the company, and then the requirements, finally the currency. We are done. So first we start like this. Let me do it here. So it's bright, light, limited. So we said we should prepare the statement of what? Profit and loss, right? So statement of the profit and loss. Please write it in full. So statement of profit or loss for the year ended 31st December. 31st December. Then you come to do 2013 here, 2012. And then the 2012, you can put comparative there. Comparative, into bracket comparative. Now for profit and loss, we have been able to identify that with this question to affect only what? Cost of sales. So we are going to copy everything again with the exception of the cost of sales where you have to make the necessary what? Adjustments. So we're going to copy everything that we see except the cost of sales. So sales is 250 and 200 respectively. So don't forget your currency. I'm reporting in cities. So right here sales. So 250,000 and 200,000 respectively. Cost of sales. First of all, the first one is 100,000. We say less what? 5,000. Less 5,000. Good. Why are we lessing 5,000? Because of the inventory valuation. Then we have what? 95,000 for the first year. And the second one is 80,000. So we less 5,000 again because the impact was 5,000, 5,000, 5,000. For both 2011, we had 5,000. 2012, 5,000. 2013, 5,000. We are doing for 2013, 2012. So take notes. So here will be 75,000, right? This one will be 75,000. Yeah. Good. So to be 75. So what's the gross profit? So GP. The gross profit will be, have you seen again? Right after you knowing the affected area, this was the issue. You knowing that it will affect only cost of sales, that's the end. The remaining items, they are just copy or paste. So what will be the gross profit? Gross profit. Any idea of gross profit? Good. So let me have your answers. 155. 155. Okay. 155 and 125. Good. So that's the gross profit. Then we go to the question and copy the remaining items because these items they don't depend on cost of sales. All the operating expenses don't depend on what? The cost of sales. They're on their own. So it will not affect it. So always identify the affected what? Items or the area. And then the impact you are done. The remaining item, copy them in. So admin, let's copy. So admin, selling and distribution. So admin is 60, 25. So 60,000 and then 25,000 and then 50, 15. Good. So what's the gross profits? And then we are done for the profit and loss. So let's go and then pick up the gross profits. So therefore the gross profit will be the net profits. The net profit will be, then we are done. So have you seen how nice the P&L is? In fact, the P&L is a bit okay. So what do you get? The 70,000 and what? 60,000. That's perfect. 70,000 and 60,000 respectively. Good. So now get it the notebook for me. Great. Now let's continue. Let's go to the statement of changes in equity. That's the retrospective application. That's the retrospective application. We said that we should go back. So that one too is a bit straightforward. With that one, you just write changes in equity in brackets, the retained earnings column only, because we said that the retrospective application simple means we have to bring the open balance of the retained earnings and what adjust it. So that is how come we are saying that we have to use the retained earnings only. So still, the name of the company must appear. So first, you also write bright light limited. And write statement of changes in equity. So statement of changes in what? Equity. Down to for the year ended. And then you start with the 2012 first. They will give you open balance. Then you write it. You have two presentations, so I'll walk you through all the two. And then you select the one that you like best, your best approach, and then you are done. So you can pick the two. Now you go to the question, they'll give you open balance, or they'll give you some balance. Tell me the year that they give you. Start from that year as well. So they gave us 1st January 2012. So I write 1st January. 1st what? January 2012. Balance what? Brought down. Ghana city of what? What was the figure? 300,000. That's all. That's all what we need. Now let's go and do the retrospective application. We said that with the retrospective application, we cannot go back. They changed the policy in 2013. We have 2012. We have 2011 going like that, right? This is where they change the policy. So let me shift it inside more. Let me push it right for small. So they changed their mind 2013. This is the normal line. 12 is here. 11, 10, and 9. So this is where they change. So it means that we have to go back and then apply this policy as if the policy has been used in the previous years. But the issue is we can't go and then take 2011 or even 2012 financial statement and then publish it out and then adjust it.
The 2009-2010 financial statement has already been published. And then it's in circulation. You can't call them, please. Our financial statement that we published 2009 contains an error. So please, all of you who are using it must be careful. No, we can't do that. So, but what is the idea? Okay, then there's a way out. The issue is that even though we can't go and then change anything from this year's financial statement, all of them, their input has been balanced. So if the balance here has been carried forward. So the balance. So the balance, the open balance that we have, we can affect that open balance, right? Because it's coming from the previous period, and that's the retrospective application. This is the open balance, 300,000. So if we can adjust this open balance with the effect of the policy, then it's the same as we going back to change it in the financial statement. So yeah, we are not going to this category and change it. And even look at the most recent financial statement before we change the policy in 2012, right? Even though we have published the 2012 financial statement, for comparison purposes, we've prepared another statement. That's what we call it what comparative information for comparison. Because 2012, the actual financial statement that we published, we use the old policy. Because by then, we've not changed the accounting policy. We are still using the old policy. So we published that one. But because we have changed it in 2013, the immediate financial statement, we have to restate it. We have to assume that the new policy that we used in 2012 was applied in 2012. The new policy that we used in 2013 was applied in 2012 to prepare the financial statement again. Good. So that is it. So for comparison purposes, we do this. So here, so they are saying that the open balance is 300,000. Good. Have you seen? So if it's open balance 300,000, we have to now adjust this 300,000. So let's look at the effect on the previous period. So from 2012 going down. What is the effect? So that means we can look at the 2011 own. So between 2011 and 2012. Here we have to pick what we have identified. How we get it? They didn't give us for 2010 and 2009, right? It does not affect that year. So there's no need for us to worry ourselves. The years that will affect, they'll give it to you. They didn't give us the end at 2011, the impact in a question, the impact. They ended at where? 2011. Meanwhile, the open balance was given to us here, right? So it means that the only application that we have to do is up to 2011. So it means that we have to adjust between 2012 and 2011, right? Because this 300 is coming from here. So it contains the old policy. So you have to apply it. Good. So therefore, now that we know, so here, are we going to increase it by 10 or 5? So here to increase by 5, here to increase by 5, here to increase by what? By 5. Here to increase by what? By 5. So, in fact, the increase is only 2. So it increased by what? By 5. But the increase, 2010 wasn't given. So the increase will start from just 11 and 12, increased by 5. So now tell us, it means that the impact from the previous years up to here is only 5. So from here to here, you are done. How do you get it? So that's 5. Great. If you understand this way, we are done. So therefore, what we will do is this. You will now come here and come and then adjust this 300,000. So now let's adjust this 300,000. So we say new policy, impact on inventory valuation. Inventory valuation impact as a result of change in accounting policy. It will be 5,000. So here are we adding or we are subtracting? You have to look at the effect on profits. This is profit, changed in equity, into bracket the retained earnings column only. So you can add it with retained earnings column. Retained what? Earnings column. So it is the retained earnings column that we have, but not the entire changes in equity. So this one is cumulative profit. So we said that as a result of this, their closing inventory has been what? Undervalued. And if the closing inventory has been undervalued, if closing inventory has been undervalued by 5,000, then it means that cost of sales has been what? Overvalued, right? If cost of sales has gone up, it means that the profit has what? Gone down. If profit has gone down, then what do you do? How do you correct it? We add back. So here we are adding. And this is how we analyze it. The same we have to do it in exam. So that time you will be there alone. This is how nice when we are analyzing it together. That one is nice. By the exam time you alone. Good. So get 305,000. 305,000. That is previous period. 305,000. So that is it. Then we move on. So this answer becomes what? Restated open balance. Reward stated open balance. Open balance. That's the 305,000. So let me write it well. 305,000. Restated what? Open balance. Restated open balance. How we get it? In fact, the issue with the retained earnings is this guy, this section. That's all. If you're able to understand this section for me, I'm done. Okay.
Good. So that is it. Then you add the correct profits for 2012. The right profits, not the wrong word profits. Have to add the right profit to it. The right profit that we have here, 60,000, right? Good. So the right profit is what? The right profit. So that's the profit for the year. It's 60,000. So I'll put the 60,000 here. Then I'll get 365,000. So that becomes the closing balance for that of what? 2012. So as of December 31st December 2012, we call it balance what? Carry down. So that's the closing balance. 365. Good. 365. 365. Then when it comes to 1st January 2013, balance brought down will still be 365,000. Then what do? Then you add the correct profit to it. From here going there, you don't need to worry at all. Correct what? Profit. The right profit that we determine for 2013 is what? 70,000. Just add it to it. So you'll be what? Sorry. So you add the 70,000 to it. Then you get the closing profit for that of what? What's the name? 2013. So 31st what? December 2000 and what? 13. Balance what? Carry down. So this needs to give us what? 435. So 435,000. That's good. So that's the solution to this question and you are done. So this is what we are going to do. Then I will have alternative version for this. Most of the time, students like the PNM, but they don't like the changes in equity. They don't do that one. So I have alternative version, simpler version. Yes. In fact, when I do that, most people like that one. So I like the long approach first before giving a shortcut out. I like this one. You okay with this one, right? So that's fine. So let me see if I can do alternative to this. Alternative. Let me clean this one here. Alternative. Alternative. Now watch how you're going to do alternative. It's same the name of the company, right? Like so changes in equity. Statement of changes in equity for the year ended. No shortcut, oh. Please, no shortcut. 20 current year 2013 and 2012 into bracket comparative. Good. This one is what comparative. So first, what do? Open balance. Write the open balance here. Open balance or the balance brought down. So let me write balance brought down. That's the balance brought down, open balance, right? Good. So here you want the wrong balances. Here we need what? The wrong balances, not the correct one. Meanwhile, in 2012, the balance that they gave us was what? 300, right? So for 2012, we know that one to be 300,000. Great. That's the open balance for 2012 from the question. But to get 2013's own, relax. Get a wrong profit. Get what? The wrong profit and then add it to it. So from the question, if 2012 they've made a open balance 300, so what will be the profit made for that year using the old version or the old policy? That's from the question. So let's go and pick it from the question. So from the question, the profit for 2012 is what? 55,000, right? Good. So therefore, it will be 55 plus what? The 300,000, right? So that means the closing balance of the retained earning as at the end of 2012 will be what? Will be 300 and what? 55. How we get it? Because they will add the profit made for that year to it. How we get it? So this profit 55,000 will be added to the open balance of the retained earnings because the retained earnings as at January to the beginning of 2012. So getting to the end, they'll add the year's end profit to it and they'll get to the closing balance. Good. So now let's go to the board. So therefore, they'll get here 3 and it become open balance for 2013. Closing for 2012 is the same as what? Open for 2013. So 355,000. Perfect. If you can do this for me, you are fine. Then the impact of the inventory valuation or change in policy, change in accounting policy. So change in accounting policy to bracket inventory valuation. Now, 2012 and then 2013. If we are going like this, we are in 2011. Here we know that is 5. Here too is 5. So if I'm standing here 2012, that means here, right? So that means from here going, it's only 5, right? From here going, from here to retrospectively. So from 2012 going, so we are in 2012. So from here going, it's only 5. The impact is just 5,000. How we get it? Good. Then, but from where? From 2013. Here, coming, it include what? This 5 and this 5, right? Making what? 10. That's all. If you understand this one, I'll be fine. From here going to be 10. So here will be what? 10,000. That's all. We are done. When we do this, you get it. So when it's 10, we said that we should add in. So we are adding. So now when you add, so we'll call this one restated open balance. Restated restated open balance. So over here, the restated open balance will be what? Add this to this. You get 300 and what? 65,000. That's the restated what? Open balance. Add this to this, you get 305,000. And then if you do it what, must comply with the same answer. Open balance restated. That's the 365,000. The correct balance, 365. And then restated 305 for 2012. The same thing there. Then add a profit made for the year, the net profit. So that one correct profit. The correct profit for 2013 is what? Correct profit for 2013 is 70,000, right? Then the correct profit for 2012 is what? 60,000, right? Uh-huh. So when we add all this, it must balance nicely for you. This and this is what? 365,000. Obviously, it's closing here, right? It must be what? Open. So the correct closing balance must be the correct open balance. Good. So in that order. So closing there becomes open here. Then you add and get 435,000. But there's a third approach there. I think this two is okay. I shouldn't go there at all. The third one has to do with this. The third one has to do with this. I can also make here 5,000. But here I'll add the correct profit to it. It was 300. Correct profit was 60,000, right? So it will be 360. This will give you the same answer. Have you seen? Yes. So that is it. Now let me change them back. So I'm done with the first illustration. So make sure that you understand every part of this. Good. That's the first illustration. Let's continue the game. So let's move on to the next illustration. That's illustration 2. The illustration 2. That's illustration 3. Good. That is the Ready Limited, right? Ready Limited. So it's yes, that's illustration 3. Okay, yes. But we did the first, second, so we're on the third one. Good. And that one is yours. So I'll read the question and then analyze it, but it will be on you. You try it. While carrying out the audit of Ready Trading Limited for 2013, it was noticed that the depreciation was noticed that the depreciation on the property, plant and equipment, that's BP, for 2012 was incorrectly recorded in the books of accounts at 30,000 instead of as 30,000 instead of what 50,000. So the extract from the income statement for the years ended 31st December 2013 and 2012 before the correction of this error is as follows. So this is what correction of what error, and that one too, it requires what retrospective restatement. How we get it? It requires what retrospective restatement, and then you are done. So that one too, let's go to the board and look at how the same show. So that one too, when you are reading errors, steps, step 1, identify the error or the mistake. 2, the affected items and then the impact. You are done. And now do the same show. This one is the error that we've identified. So tell us So the error was like this. Depreciation supposed to be 50,000 cedis in one of the years. In one of the years. So let's see which of the year they had it wrong. For 2012. So for 2012 it was wrong. So 2012 wrong. No, 2013 they had it correct. This is the right one. But this is what they did over here. Instead of the 50,000, they recorded what? 30,000. That is it. So we've been able to what? Identify the mistake. So the mistake had to do with what? Depreciation. So look at where they do depreciation. That's the only place to affect. All the other items that do not depend on depreciation, they are free. You just copy them. Uh-huh. In exams, we try as much as possible to limit some of the free items. That's the only issue. Now let's continue the game. There was one of the items in the question that makes it interesting. The gross profit. Everything we start from gross profit because sales cost of sales will not be affected. We are reducing the free marks. Good. General and admin expense will not be affected. Sell distribution will not be affected. So the first two will not be affected. Depreciation. You can see 50,000 in 2013 and what? 30,000 where? 2012. So that was the error that they're supposed to be 50. Good. So what do? We got it. Now, net income before income tax, they are there. Income taxes, they're also there. Net profit, all of them are there. Then the retained earnings of Breading Trading Limited for 2013 and 2012 before the correction of errors, they are. In fact, all what they provided the example, you won't do that. Not at all. It should like the first one. Thank you. We need only one, the opening balance of the preceding year. So we give you the 50,000. So in exams, only this 50,000 be given to you. That's all. The rest you can do it by yourself. If you want the closing balance of the retained earnings for that of 2012, what do? Add the wrong profit made to it. You get the closing balance. The profit is 168. And then you push it forward, becomes the opening balance. After adding the profit to the opening balance, you get 218. Push it as opening balance to 2013. Then add the wrong profit in the question. That's 176. Add it to it. It will give you the closing balance. That is it. So take note. Hey, where are we? Okay. Now they are saying that Radio Trading Limited income tax is at the rate of what? 20%. So we are start with taxes. If I do taxes, that means I am getting to the end. Taxes, income tax, and then you'll be fine. Now let's see. So now you'll be able to identify. So in the income statement, straightforward. Instead of recording 20 here, just make here 50. That's all. So it means 2013 will not be affected. True or false? There's no error. There's no mistake in 2013. So you just copy it again. So the only mistake is what 2012 where they make the 50,000 30. That's all. So that is it. So help me copy the question again as the solution for 2013. Nothing will change because so now want to as usual we start very limited. So yeah, our shortcut is to finish early. P&L 2013 and 2012. For 2013, nothing will change. So let's copy everything. You see there. They started from gross profit to reduce the free marks. So the gross profits are 400,000 and 350,000. Now, what again? The operating expenses. First, So general and admin, that one is 80,000 and then 90,000. Or 9080. Okay. Then the next one, we have selling and distribution, which is what? 50/20. Okay, so you put all of them in a nice bracket. Then almighty depreciation. Add the depreciation here, and that will be depreciation. Here will be 50. So depreciation, let's go to the board. So for depreciation, here will be 50,000. Depreciation here will be 50,000. And here to be what? 50,000. That's where the error is. They made it 30. We are adding 20 to it, right? Good. We are adding 20 to this figure. So therefore, the profit before depreciation will be, that's profit before tax. And the profit before tax will still be 220,000, right? And then that of 2012 will be, so that will be 350 less 90 less 70,000. That's 190. 190,000. Then you go to income tax. Now, before you go to tax, I'm going to do a separate working for tax. It's very important. When I done, I'll give you a shortcut. But I don't like that shortcut. I like the long approach. Good. So let's see. Anytime they give you tax rate in the question, that means we have to calculate our own tax. So what you have to do is this. You have to go and do separate working. Let's call it workings number 1. Income tax. So for tax, I'll put 2013 here, 2012 here, and say per question. What's the tax per the question? Yeah, 2013, 44, right? It's 44 and then here is 38 and here is 42,000. Then I'll say error. The tax effect of the error. The error is that, or the mistake they committed was the expenses was understated by what? 20,000. Agreed. Yeah, depreciation they used 30,000 instead of what? 50. So the same as what? The expenses went down by what? 20,000. So if expenses went down by 20,000, what happened to their profit? Tell me. If the expenses go down, profit will go up, right? Profit and tax are twins. They move together. Profit and tax, because the tax authority, the more you are getting profit, the more they are also taxing you and they get their money. So they are like twins. Tax man and profit, like a twin. Good. So when you see a profit, tax too will be there. Good. So it means that the tax that we have shown there is too high as a result of the mistake that we did here, because our expense has gone down, so the profit has gone up. Profit has shoot up. So because profit has gone up, tax 2 will follow the same lane. So tax 2 will also follow the same lane. Tax 2 has also gone up. So this tax that we are paying is high. These taxes are high because of the mistake that we did. It has ended up letting us pay more tax than we're supposed to. So what do? Let's calculate the tax effect, and what we do, we subtract. So what is the tax effect on this 20,000? the tax what effect on this 20,000. So that is it. So we do what? We subtract because our taxes that we are paying is too high because we have an award estimate the expense. Profit will go up. When profit go up, tax will almost go up, which is a mistake, not a good news. So therefore, we are going to subtract. So error. So that's the tax effect. Tax effect of the error. So find the mistake, multiply by the tax rate. That's all. What's the tax rate? So multiplied by 20%. What do you get? It's 4,000, right? Good. So by 2013, because there's no mistake in 2013 to be dashed, right? But 2013, there's no error, there's no mistake. So it will affect what? Only 2012, 4,000. So you subtract. So therefore, the right tax that we're supposed to key in will be what? So tax will be here to be 44,000, and you'll be what? 38,000. Mhm. Now, let you understand this one very well before I give you the shortcut. A shortcut is that just that shortcuts are dangerous. Most of them are dangerous. They're always dangerous. Check. Go to the question. If you go to the question, pick the tax rate and multiply by the profit before tax for both years. Whether to give you the tax that is stated in your question. So let's go and confirm. So you pick the tax rate is 20%. The net income before tax here is 220, right? So 220 by 20%, that will give us 44. Good. Now let's try the second one too. Second one, they had 210. So 210 by 20%, that will give us what? 42. Oh, when you do that, and then they are the same, just clap for the examiner. You don't need to do this one too. When you come and just multiply by 20%, 20%, give me the same answer. How we get it? So it means that it's 44,000 and it's 38. 38, you multiply this one by 20%, you get the same answer. Multiply this one by 20%, get the same answer. But if you do it and you're not getting it, don't come and do that one here. That one if you are wrong. If you confirm from the question, you multiply, you're not getting what they're doing. But I've done some of the questions like that intentionally. I did it like that. You can't you're not going to get it. That means you'll be forced to use this approach. Good. So understand this approach for me. This approach, whether the tax rate confirmed, the tax rate does not confirm, you get it correct. Good. So that. So for tax you subtract as usual. For tax you have to subtract. So what is the profit after tax? Antipart. Antipart will be equal to antipart. That's the 220 less 44. So you can copy the one in the question, right? The one in the question is still the same. So 176. Good. So here's 176. And the net effect is 16,000. So the same as we subtracting 16,000 from this. So that'll give us 50, 56, 156, right? Did you get that? Or 152? Mm-hmm. Is any answer for me? One 152. Good. That's 152,000. Okay. So that is the end of the P&L. Servicing is not all that difficult. For estimate, we know where we get you. 9 16, you get you nicely under the estimate. Now let's see how the changes in equity will look like. Then from here, we can now tackle the exams questions. Gradually, we are moving there, we are getting there. Now that we are done with tax, please, the tax issue get clear. I like these versions, even though I have two alternatives. Two alternatives. Good. Now let's see. Now let's go to the change in equity here. Can I get the tax? Go in, that, gone. So changes in equity. Changes in the equity into bracket the retained earnings column only. So the name of the company again. So statement of changes in equity for the year ended. First, here is the simplest approach. 13 and 2012 in the bracket comparative. Comparative. So comparative. So first, open balance. We need the open balance. What's the retained earning balance? The wrong one, not the correct balance. So balance brought down. Here's 218 cities, right? 218 cities. And here's 50 cities, right? That's 50,000. Agreed. Now, these two balance, tell me which of them contain the mistake. These two balance, all of them contain mistake. Or the error affect all of them, right? So tell me specific where the error will affect. Yes, in fact, the first method for the tax always work. How we calculated it, that one always, it work. And that's what I want. Not a shortcut that we use by multiplying this one by the 20%. That one sometimes does not work. And I have a question that will not work for you. So if you go and multiply, you get it wrong. But the first method that we use, where we have to look at the impact on tax, impact on profit, and we link it to what? To that of the tax. That one always work, and then you are fine. That's great. Good. Now, which of these two open balances contains the error or contains mistake? All the two. All the two. Why? Okay, explain. Tell me individually. Mm-hmm. Uh-huh. Mm-hmm. Oh, okay. Okay. Good. Friends online. Any idea which of these contains the error? Fact. Okay. Now let's see. Now let's see what happened. The open balance for 2012 is what? Balance brought down. Let's do some rough calculation here. It's 50, right? How we get it? And then they made a mistake. The wrong profit was 68. So they added 68 to it, right? Or it wasn't 68. The wrong profit. From the question. Let's go to the question. 168, good. So the wrong profit was 168. So that's the profit after tax. So they'll get what? 218. So this was the one that contains the mistake. Agreed. The mistake is in what? It's in the 168. Good. So they get a closing balance. And then they push it to 2013. And they add the profits. That year's profit of 176. It's 176 though. But I made it 76. So check for me. So they added a 176 to it. And then they get what? In In fact, we should even end here. This 218 and this 50, which of them contains the error? But the error is in 218, not in this 50. This 50 does not contain the mistake. I hope you get it. Why? Because the mistake occurred during 2012. This one is open balance coming from where? 2011, previous year's balances. So the error will not affect the 50. So 50, they write here error or the mistake, here will be dash because it does not contain the error. How we get it? Good. So let's see. 2013 contains the error. That is where this profit, they're supposed to subtract depreciation of 50, but they subtracted what? 30. So left with what? 20. So you have to subtract the 20, right? That's all. And now this one is cumulated profit. This one is what? Cumulated profit. And what you're going to do is what? An expense. So expense and profits, they become negative and positive, right? They will subtract. Yes. So they will do what? They will subtract. So here we have to less 20. So we start by saying error. Just that we have to get the net of tax because the items go to changes in equity are profit after tax. That's what we send to change in equity. So if there's a tax in the question, find the net of tax. If the tax is 20%, net of tax will be what? 80, right? Good. So then net of tax will be 80. If the tax rate is 25, net of tax will be what? 75 in that order. So it will be 80% of the error. That is what? 20,000. And that will give us 16,000. So you less it 16,000. How we get it? Good. I like that. I like that. In fact, I like your answer. 218. In fact, I like it. That's right. 218. I should be checking. I should be checking on the screen. This is what you get. So that's the restated open balance. So therefore, the restated open balance will be what? So restated open balance. That will give us good 16,000. I like the 16. Good. I like the 16. I can see 16 on the screen. Is it 16? This is what we get. So after taking 16,000 from 218, here it will still be 50,000. Let me write the 50,000 here. What about 2013? 202. 202. In fact, I like that too. 202. That's great. So that's the restated open balance. In fact, if you can get this section correct, the rest we are done. Add the profit after tax to it, the correct profit. The correct profit. What's the correct profit here? It's 152. So it will be 176,000. And then over here is 152. 152,000. And then you balance it off nicely. If you put this in this, you get 202,000. It was closing here. That is the correct open balance. Have you seen? That's balanced nicely. Then you are going like that. So in exams, that's how we want you to code the solution for us, okay? And then you'll be fine. So here will be what? Finally, 378,000. So we are done. So this becomes the closing balance. So balance carry down as at the end of the year. So I am done for the illustration questions. So now what level is tutorial questions? Good. I'll solve one of the tutorial questions. If you try it. Because instead that I should do this one, you try that. So but that one does not have solution. Thank God that the one that you are solving there's no solution. Thank God. And that one is my handwriting. Okay, thank God. Good. The time is so yeah. Good. So any question, any suggestion before we start with the tutorial questions? So whilst you are going through, you can bring your questions on board. Okay. Wow. Okay, so the next question, you will try it and then we'll see. So let's go to the tutorial questions. Tutorial questions. Good. Tutorial question one. Tutorial question one. You try the tax issue and see first. So confirm the tax. In fact, if you multiply 20% by the profit before tax, 295, I get 70. 295 by 20%. So that means you have to be forced to do the first method. Good. So that's the first thing. Check. So required. Prepare the statement of profit or loss and the statement of change in equity into bracket the retained earnings column only. You don't need the whole change in equity. For the year ended 2017, that's the current year. And 2016 as what? Comparative. If you see the word comparative in the question, that means that question either there's an error in the question, it's an error question, or accounting policy, change accounting policy. For estimate, we don't go back. So estimate, there's no comparative restatement. For estimate. That's good. So I suspect that this question is what change in accounting policy or what error. Now let's go through and see. One question can contain all the three. Oh. Yes, all the three can be. That's question number 4. The last question is what your exam question. Now, this is the whole show. During 2017, Target Publications Limited changed its accounting policy for the treatment of the borrowing cost that are directly attributable to a qualifying asset that is under construction. In previous periods, management had capitalized such costs. Management has now decided to expense rather than capitalizing them. Management judged that the new policy is preferable because it will result in more transparent treatment of finance costs and is consistent with the local industrial or the industry practice, making the entity's financial statement more comparable. Making the entity's financial statement more comparable. That means to provide more relevant information. So that is it. The entity capitalized borrowing costs incurred for 20 million 2012, 2017, 12. That's from you. And then 50 million 2016, and then 40 million in the period prior to what? 2016. I like this question. I like this question. Uh-huh. But I had wanted you to solve the easy one. You said no. Question work. I think you do not get your turn. Good. So all borrowing costs incurred in the previous years were in respect of the construction of all qualifying assets were capitalized. The extract from the income statement for the years ended 31st December 2017 and 2016 before the change in accounting policy is as follows. So I'm helping you to read. Revenue is there, gross profit, operating cost, profit before interest and tax, interest expense dash, income tax. And then note, in 2016, the opening balance of the retained earnings is 450 million. The entity does not have Any other long-term debt aside the one secured for the construction of the qualifying asset. That's good. So we are done. Start work. Kindly pause the video and then work it out before you continue. Good. Good. Now let's see how best we can solve the question. So first, as usual, this question is a bit lengthy. I'll start with the target publication. The name of the company is what? Target publication. So statement of what? Profit or loss. So I'll start from the gross profit for the current year, 2017 and what? 2016 as what? Comparative. 2016 as what? Comparative. Okay. Okay, it's a bit okay. Don't forget your currency is millions, so it must be there. Millions. It's part of the 100 now. Now let's go to the question and see where we will start from. So the question, in fact, the issue is this. The issue has to do with the finance cost. Formerly, the finance cost, they were capitalizing it, meaning treating it as what? Asset. Adding it to their assets, right? But now they are saying they are going to do what? Expense it. That's it. So it means that tell me where it will affect. It will only affect what? The finance cost, that's all. So you're from revenue up to profit before interest and tax, nothing to not be affected. So that section, you can copy them correctly. So in real exam situation, I will start the question from the profit before interest and tax. We will not start it from revenue, so that you get a lot of free marks. So take note. So this question, we are awarding free marks in it. So it means that only the finance cost section will be affected. And then they were saying that the finance cost, they were capitalizing it. They were doing what? Capitalizing, treating it as an asset. And then they don't have any other loan. You are not paying any other finance cost. So that's why the finance cost in the question was what? Zero or dash. Because the only finance cost that they have capitalized it. So there's no finance cost again. So the interest expenses were dash. I intentionally did that. Put that dash there. So now we are going to bring a figure there. So can I start from the profit before interest and tax? How we get it? Good. So I'll start from there. Even though an exam condition, you start from the revenue down there, right? Good. Good. So I'll start from the profit before interest and tax. Even though in exams, you can start from the revenue down up here, everything will still be the same to not be affected. Because we've identified that it will affect the finance cost. So from the revenue to this place will not be affected. So kindly copy that one and adjust it for me. So that means in exams, you copy the revenue, copy everything up to the finance, profit before interest and tax. That's the free marks. But where the examiner tries to limit you or prevent a lot of the free marks, what do you do? So that's the situation. That's a question number what? 2. Or actually, all. Good. So that is it. I hope you get it. So revenue will be the same. So do it up to that section for me. So revenue down, down, up to what? Profit before interest and tax. It's still the same. So you can copy it from the question. So let me start from the, 2016 and what? 2016 as what? Comparative. So you're from revenue up to profit before interest and tax. So that is it. So revenue down, down, up to what? Profit before interest and tax. It's still the same. So you can copy it from the question. So you can copy it from the question. So let me start from the Profit before interest and tax. 295 and 280, right? So it will be 295 and 280. That is it. Then finance cost. Now they are expensing it. Finance what? Cost. What is the finance cost? The interest expense. So here they call it interest expense. So let's also call it interest expense, which is the same as the finance cost. So now go to the question. What was the finance cost for 2017 and 2016? That's all. So what's the finance cost for 2017, 2016? That's all. So here will be 20 million and what? 50 million. The finance cost for 2016 is 50 million, but not what? 90 million. They were saying that, when they do the normal line, they change their mind in 2017. So previous year 2016 and prior to 2016. So from 15 going like this. So here they incur 20, 2016 they incur 50. But from here going, they incur what? 40 million. So you need a 90 when they're doing the changes in equity. So I like the 90 that you place in there. It's very good. So that is it. So your finance cost will be 2050 and it ends there. How we get it? Good. So that is it. So to be 50. So you have to pick the cost that we incurred for that year. Good. So you take it off. So what do you get? So that's the profit before tax. Profit before tax. That's 275, right? And you got 230. Agree. Perfect. So tax. Now let's go and do the what we identified, or what the first method that we stated. So tax workings. So tax, we have 2017 and 2016. 17 and 16. So per question. Per the question. Per the question. So per question, what's the income tax given to us in the question? So 70 and 60 million. And what's the rate? 20%, right? The income tax rate was 20%. Good. So the issue is, what was the impact? Now, the borrowing cost, they capitalize it. So it has underestimated, or they have what? Underestimate the expense. So the expense will go down. Expenses go down. Why? That's what they've done. Because they did not what? They did not expense, they did not subtract the finance cost. So that means the expense were more. That means the expenses were what? The issue is this. The expenses were underestimated by 20 and 50 especially. That means they're supposed to subtract 20 in addition. They did not. So what do we have to do? So they have omitted a whole interest from the P&L. So to let the expenses be what? Low. And when the expenses go down, what happens to profit? So the profit will be what? Will go high. And we said that profit and tax are what? Twins. So tax too will also what? Go high. So in correcting it, the effect on tax will be that the tax will go down, right? Because this 20 will come and reduce their profit. Good. So here is the change in accounting policy, but here is not error. This question is not error. It's a change in accounting policy. So right, change in policy, effect on tax. So the change in the policy, its effect on what? Tax. Effect on tax. Good. So it means that the tax has gone up as a result of the profit going up. the tax is also up. Meanwhile, it's supposed to what? Come down. So that is it. So have you seen the analysis of this? If you can analyze like this, then that's all. Don't worry. Don't need to worry at all. So let's find the tax effect. What was the error? No, sorry, what was the impact? Not a mistake. The impact will be for 2017, it was 20, right? So it'll be 20 times 20%. That will give us 4 Ghana cedis. You take it off. For that of 2016, it will be 50 Ghana times what? 20%, and that will give us 10. So you take off 10. So this one will give us what? 64 and what? 70, right? Or 50. So that's the tax. How we get it? Good. So this is what you do to get a tax, and then you are fine. This one is 50. That's the error. Sorry, that's the effect, the impact. You multiply by the tax rate, and then you are done. A 66 and okay, not 64. Good. And then this one is 50, right? Okay. Good. So we bring them here. Income tax, workings W or 1. That's workings 1. You take 66 from it, and you take what? 50 from it. We are done. So this is a profit after tax antipart. So antipart will be what? Something 9. So 209 and 180. So that is it. How we get it? So this is how the profit look like. That means it's not difficult. Not at all. It's a principle and a procedure. Just follow it. Pick it there, you are done.
So the 100 question, you cannot call it.
I'm not gonna question, no, you can't call for explanation. How can I answer the question but I'm not gonna answer this and then you have call for it. Then I'm solving it too. Then I'll share the money with you. And then we share, I'll give you 20 Ghana, take it together. Good. So that is it. Now let me the changes in equity, right? Let's go into the changes in equity. Yeah, I'll use the shortcut approach or the long one, right? The vertical one. Please, I hope everyone gets it. Now let's go ahead to do the changes in the equity, and then you'll be fine. In fact, everyone is fine. Good. Now let's see. So target publication. So statement of changes in equity. And here I'll use in fact, I'll do the all the two method. So I'll go by my first approach. First approach is where they give the open balance. All the open balance. What is the open balance given to us? The open balance given to us is 150 million. Which year? So 1st January 2016, right? We will give the previous year's open balance. Good. So it's 450 million. Then now we changed the policy in 2017. 2017, 2016. But this one given to us is what? 16, right? is 16. So this open balance is 16, so it must take effect from prior to what 2016, before 2016. So from here going, and that's the 40 million given to us, right? Prior to 2016, the finance cost incurred was what 40 million. Agreed. Prior to 2016, let's go to the question. They give us the finance cost respectfully. The finance cost was there. Let's go to the notes. It said that the entity's capitalized borrowing cost incurred, or the capitalized borrowing cost incurred of 20 million in 2017, 50 million in what? 2016. And before 2016 too, they've already incurred what? 40 million. Have you seen? Uh-huh. So if before 2016 they've incurred 40 million, before 2016 they've incurred what 40 million, and if open balance is as at 2016, then is that the one that we're looking for? Good. So you have to pick the one just before the what? The open balance. Uh-huh. Good. So here we tell exam. We will pick the one just before, or we pick the balances prior to the open balance. We pick the cumulative effect prior to what? The open balance given to you. The balance 2016, so you have to pick the one, all the issues before this open balance of the
So
450.
let's say 2018 now, and they gave you for 2017.
So let us know if we have 2018. When they change their mind? Tell us.
They changed it to 2017.
They changed the mind in 2017 like this. Then we still, and then what's the open balance? When are they giving the open balance?
They gave you, okay, they gave you open balance for 20. Okay, they changed their mind in 2017.
And they give the open balance of what?
Okay, so anywhere they give the opening balance, yeah, then you go and pick the prior.
Exactly, the prior period items. So anywhere they give you the open balance, pick what? The prior period items, and then you are done. Good. Okay, so
Actually they didn't give us any 40 million. You just write it.
and it's Ash. In fact, you are getting closer to the question 3. You are getting closer to the question 3. Like you are aiming at the 100 Ghana cedis.
I don't think yes. You sometimes you can outdo this one.
The crazy side.
Or a million. People will get something.
Good. So that is it. Now, but it must be capital letter. So the change in accounting policy. So effect on change in accounting policy. Effect on change in accounting policy. Don't forget that there's tax in the question. So you have to pick what? Net of what? Tax. So therefore, what we do is this. Open your bracket. We've identified that we have to pick the 40 million because that one was prior to what? 2016. Good. So pick that 40 million. The tax rate is 20%. So the net of tax will be what? 80. So times 80%. And that will give us 80% of 40. 32. So here will be 32 series. Will you add or you subtract? It's a finance cost. This one's cumulative profit. Finance cost cumulative profit. So you subtract, right? Good. In fact, whatever you subtract to there. So we call this one restated what? Open balance. So call it restated open balance. So what's the answer? 418. Then you add the correct profit after tax to it. What's the correct profit after tax for 2016? 180, right? So that's 180. So correct profit after tax is 180. Add it to it. It will give you the closing balance. So you'll be 598. We call it balance as at 31st December 2016. Balance carry down. Just double underline it. Go to the next year, open a new page, call it 1st January 2017. Balance brought down. So the same figure 598. What do? Then you say profit made for that year. So profit after tax. The correct profit of that's what 209, this figure. So I'll add a 209 to it. I am done. Good. And this one becomes as of 31st December 2017. Balance carry downwards. So you add them together. Here will be 7. Here will be 0. Here will be what? 8, right? We are done. So that's the end of the game. I will try an alternative version here. So for you to get it well. I'll try the alternative version. The alternative version. The alternative version. If you do have any question, kindly put it in the comment section. I'll pick it up or the chat section. I'll be seeing it right. Good. Now let's go ahead and do the alternative. For the statement of changes in equity, alternative version. Alternative. Alternative version. Now what you do is this. You write both 2013 here, 2012. You record the opening balance. Your opening balance is 450. If I'm writing 13 and what? 12. You are forgetting that this question we are doing 2017 and 2016. Ghana cedis is in millions. The cedis are in millions. So the opening balance, let me call it balance brought down. Here is 450, right? How we get it? 2016, what was the wrong profit? What's the wrong profit for 2016? The wrong profit from the question. Friends online. 220, right? That's the wrong profit. Add it to the opening balance of the retained earnings to give you the closing balance, and then we send it here as what? Opening balance for 2016. So that is it. For 2017, sorry. So 450 is the opening balance plus 220, that will give us 670, right? So that's the opening balance, the wrong one. How we get it? Wow, great, 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 great. So that is it. I like it. Someone quoted it on the platform, so that's great. Now you come here, the impact or the effect of the change in accounting policy. So you find the net of tax. Now we are in 2016, 2017. So if you are in 2017 and then 2016, meanwhile here is 20, here is 50, and then from here going, from 2015 going is what? 40. Great. So the question is, if I'm 2016, then it means that from 2016, prior to 2016, it will still be what? The 40, right? Prior to 2016 will still be 40. Net of tax, 80% on it to give you 32, right? Net of tax. Good. But let me do the workings here. To bracket 80% times 40. That will give me 32. Then if I'm 2017, now I'm here. So to start, prior to 2017, so it means that this figure is not part. The remaining ones, right? So this one will not be part. So from here going, right? Prior to we are in 2017, so we want to find the figure that will come here. So it will be for 2017, and it will be what? It will be this and then this one, right? So making the 50 and the 40, making 90. How we get it? So prior to 2017, it was 90. Prior to 2016, it was 40. How we get it? So that is it. How everyone get it? Good. So it means that here it will be 90. So say 90 times what? 80%, that's net of tax times what? 90, and that will give us, that's a net of tax. Net of tax. 80% of 90. 80% of 90. 72, good. This is a finance cost. So do we add or we subtract? Good. So subtract here and subtract there. So what do we get? Here will give 418, and here will give us, so we call this one restated open balance. 598, good. Then you bring your profit after tax, the good profit, the right one. The profit after tax respectively was 209 and 180, right? So you put them together, then get a closing balance. So this will be the closing balance. Balance what? Carry down. Put this and this together. Yeah, you get 598, and you'll give us 807, and then you add that. So it must give you the same answer. So this is how we want the solution to be like. So for question 2 is yours. If you have any question, kindly ask before I give my holiday assignments. Sorry, weekend assignment. Yes, holiday. Monday is holiday, right? Yes, we will come. Just that we come. Okay, Monday is holiday. Okay, we will discuss that. So now you get this one. So based on this idea, you can use this answer question 2 because they are twins. Question 1 and 2 are twins. It's directly opposite. So if you look at question 2 too, they are saying formerly they were expensing it. Now they are doing what? They are capitalizing it. That's all. Now they are capitalizing it. So that's the difference. And then question 3 is a trial. Going forward. Going for 100 Ghana cedis. Then question 4. In fact, question 2 and 4, you are doing it. Question 4 is your exam pass question. That one you can try. Question 4 is there. Question 4. So question 4 is ICA November 2018. 2018 past version. Please try it for us and then you'll be fine. Good. So try them. If you have any issue, you can let me know. But there will be some mock. Some of the questions must be ready. So I'll communicate to you. If you are done with maybe 4 standards, we combine and mock 4 questions on them. And then you do them for me. Short standards. Then we are done. Great. So that is the end of the game. If you do have any question, kindly let me know. Good. Kindly subscribe to the YouTube channel if you've not done that. And then turn on the notification button so that anytime we upload a video, you will get the notification easily and instant. So that is it, and you'll be fine. So our next standard will be IAS 10. That's the next standard. IAS 10. Events after reporting period. That's the next standard. And after that, we do the IAS 12 tax. And then we're done with the first set of the standards. That's good news. Good. So that's it. So goodbye.